Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Last week, the corn futures contracts had a massive response to the USDA reports. In particular, the planting intentions really caused havoc to corn prices. You'll notice here on this chart we had a very big drop-off on Thursday when the announcements were made. That drop-off was due to the surprise number that came in with the planting intentions. But we also want to take note here of how effective technical analysis is for us when viewing the markets. In spite of what was a almost 20-point drop, you'll notice how the market came into our 180-degree projected support level that also coincided with volatility-based support. And it is at this level that you saw the market come in, pause on that day, and over the last 3 to 4 trading days, the market has actually been basing off of that low. So the technical analysis in conjunction with the fundamentals play a very key role in helping us understand where prices may move. Also, we had mentioned before that upon breaking our natural trend line that we expected prices to break down. Now mind you, we didn't expect this massive move as fast as it occurred, but it is very helpful to understand how key natural support and resistance levels that the markets will tend to respond to these levels. We had support coming in at around 366.5, which had contained the market for quite some time, and upon breaking it here, we can see the conjunction of those 2 points. Once the market broke here, we had a very nice drop off from that area. The chart with our natural angles was very similar in nature. You'll notice how the market really contained great support all the way along this natural angle, and upon breaking here, we saw the big rundown that occurred. Also, you'll see here that the recent lows also coincided here with our natural angle support level. And so we see a nice matchup occurring with regards to the two sets of analyses on the two different types of charts, but yielding the same information for us. A few key levels that we want to keep on our minds this week as we look at the markets and as we consider how we want to price our inventory. We have a couple key support and resistance levels for us. You'll notice that 2 standard deviations below the point of control is at about 353.5. Then we have 371.25 is the next level above that. And our key point of control continues to be right around the 400 mark, currently sitting at 396. So if prices come up near any one of these thresholds and fails, we could very well see another rundown in these markets here. The exception that could cause prices to hold up would be some weather events that cause prices to find some strength. But other than that, inventory-wise, we continue to look for the markets to find continued pressure. For the December contract, we find much of the same. We see a nice break off of what had been key support. The market was consolidating inside of a range. That key node level was at about 385.75 to about 386. Upon really getting a clean break of this region or of this zone, the market made a very nice rundown, but you see here the market came in right inside of our key 180-degree price level of 366.5, which is where it found support. We also see that it tagged right up against one of our end bands, and this is where we find a bit of consolidation. Now the market has really only regained about 30% of this big downdraft here. And so unless it's really able to get up above perhaps 376 mark, we're really probably predisposed to seeing another rundown happen probably as the week matures and as we see prices continue to tick each day. In this chart with natural angles, we'll see much of the same information. The market really found great resistance along this natural angle. We saw a final mark as it tagged as it got close to this green support or resistance line rather. Upon hitting here, the market found great strength and continued to break very well, breaking along this other natural angle here. And then we found natural support, and we have the same consolidation that we've been seeing. Some key levels I want to bring to our attention with regards to the December contract. We have our point of control that sits at 391. If prices come up to about 391, we anticipate very good resistance there. 391 lands us very close to where we were across the top, and so we have quite a bit of room between here and there. The real points that we want to look at right now in terms of near term, prices currently sit at about 369.5, and so directly above it we're sitting at 378.5 with good resistance, which puts us right here at our green level. Now, prices are already struggling, as you can see in today's price action, but markets will do that day in and day out in terms of up and down movement. And so as we look at our key support and resistance levels, we have 364, 378.5, and 391 are the near-term key levels that we'll be looking at for where the markets will find a key resistance. And below we have 364, as mentioned just a second ago. Upon breaking 364, should that occur, then we could really see a very good downdraft to the downside with regards to this corn futures contract. Now, the soybean contract has been inside of a consolidation for quite some time. It made a very key low near our 180-degree mark here, then had a very strong advance, but from that advance, we have what I call, or we like to call, kind of a creeping trend or consolidating movement. It makes a move up, and we get about 5 legs inside of this movement here on his way up, making his first low coming in here. So we get 1, 2, 3, 4, and then a 5 or 5th leg top here. Now, upon making those 5 legs, we want to figure out how this guy wants to resolve itself outside of this trend. What we mean by resolution outside of that creeping movement or that consolidation is one of 2 things will typically occur. Once he breaks out of here and makes kind of his final 5th leg move, we would look for a move, and if it makes a lower high or a lower top outside of this consolidation, this could really make for a very strong move to the downside. Now, on the flip side, he could very well come in and then make a consolidation to the upside, and if he is able to actually make a higher low, he could very well take off to the upside. And so when we see a consolidation movement like this, this really bespeaks of indecision with regards to where the market wants to go. Now, the past couple days, we've seen some good moves to the downside after topping. We saw this spike after the USDA report last week, but that did not hold, and so there were a bit of internals that were conflicting with regards to a bullish versus bearish. Now, the market has come in, and now he's telling us that perhaps the market is weaker, inventory continues to be large, and the market is now making its way back down. And it's also important to note that when markets make it to your 360 and 180 levels, oftentimes what we have found that these levels are very, very important, and the markets have very challenging or very tough times making it through or breaking through those areas. Now, mind you, when they do or when they are able to break through those areas, what had been previous strong support or resistance becomes strong support or resistance in the opposite direction. We're seeing here he's having a tough time breaking through, which leads us to believe that we could very well come down and maybe find intermediate support near the 90-degree level. If that fails to hold, then he should make it back down to the 180 mark. If the 90-degree mark does in fact hold, then that tells us that the next time through 360, he should go up and perhaps test that 940 mark. But we also believe that it's been very wise, or we've noticed how producers have been taking money off the table here, pricing near the 900 mark or the $9 mark, realizing that these prices may not come back again for quite some time. Interestingly enough, we'll look at our natural angles chart. We'll see that the tops that were made are very much in conjunction with previously forecasted future resistance, which also ties in with the previous high that it made back several months ago. Now, we have our natural resistance level here. If this market continues to find weakness and breaks, we are looking for a very nice move to the downside. And so again, it's perhaps wise at the very least to to be pricing near these price thresholds, because if market's not able to hold up inside these areas, it could again be some time late into the summer before the market even considers mounting a reasonable rally again. November beans is much of the same. We saw this consolidation, which basically told us that the market was in a tight consolidation move when it became overbought, but it wasn't really breaking. And so now it's breaking out of that area, and in conjunction with that happening, hitting our 180-degree mark, he's now finding some weakness. And so we look for near-term support, perhaps near the 270-degree mark, which is at about 893. Key support and resistance levels we now find for this November contract. We have our point of control sitting at 889.5. The recent highs that we saw was one standard deviation away from the point of control, which is essentially what sent the market down from here. And then the near-term support levels just below that would be at 871 3/4 or 872, and below that we're looking at 850. July wheat has really found it tough to get through this 180-degree mark that we've been mentioning with the other charts. The 180-degree mark for this July wheat contract sits at 487. And you'll also notice that it is in conjunction with volatility-based resistance just above. Inside of this zone, markets are often neutral, and once it breaks either side of these, we then get a potential good trend. So above this side of the zones, we're looking for continued strength, and below this side of these zones, we're looking for continued weakness. Now, we'll notice that each time he's tagged above here, he's found a great resistance, and as he's tagged along the bottom, he has found support. And so that is consistent with the price action that we're looking at here. As the market has come in, the last two times he's touched, he's fallen down quite hard, and then today we're seeing quite a big move down in conjunction with being overbought, with the market looking to point downward here. So in all likelihood, we're probably looking at the next time down. If he's able to break this 465 level, we're probably looking at a test of about 447, 448 with this July contract. Our natural angles tell us much of the same. The market's been banging up against our natural resistance level inside of here. That level sits at roughly 482 1/4, which is the point of control. No surprise there. One standard deviation below the point of control brings us down to 450, which is that price threshold that we talked about just a moment ago on the previous chart. In closing, we'll have a look at the May futures contract for crude oil. The market came in, and we've talked about this before. We saw a nice little move in this advance coming into our March 11 timeline. He broke for a couple of days, then gave us a nice little spike up. And we talked about how the market would either move up or move down into our April 8th timeline. Well, today's April 6th, and as we're looking here, plus or minus a day or two of either side, the market really looks like he's making a low coming into this April 8th timeline. What that tells us is that the market could very well make an advance on the other side that could look to reach that 43.95 area or so, or even the 43.08 rather, which is the closer near-term target that we're looking at. Now, the market is also very close to our end band for this zone, and so support inside of here is starting to really look good. There's now talk that a potential oil production freeze is on the horizon, but those talks have come back and forth, and so really a freeze is not going to happen until a freeze actually happens. And so we're not going to put our weight on what the media or what the pundits keep telling us in terms of what may or may not happen. And so we will simply lean on what the technicals are telling us, and the market has come in. You'll see a natural angle that's come through. If we're able to hold very well above this area coming into this April 8th timeline, and if the market finds continued strength, then that 43.08 number is probably realistic for us. And beyond that, we can even see potentially about 43.95 to 44. Thank you so much for joining us today for our weekly market update, and look forward to spending time with you again next week.